Good morning. It's April 16th, 8:43 a.m. Central Time. This is Rich Pawson for the Critical Point podcast, and we're going to talk about the stock market, but let's begin with a little bit of news. We realize a lot of these podcast updates are just results of the model, and we do want to discuss some of the things we look at subjectively, objectively, quantitative-wise, and qualitative. In the end, we want to be more quantitative than anything. And let's take a look here. This morning, jobless claims soar by 5.25 million to push coronavirus tide layoffs above 20 million. Some say this probably means unemployment's up to 15% now. So that is in supercycle territory when you would expect a severe recession, great recession, and knocking on the door of a depression. I think I want to see 20% or more before I say a depression relative to unemployment. Now, something to look at is that this morning the number was a little higher than the average trade guess of 5 million. We want to look at this chart here on marketwatch.com, and we can see that this is the third week now of declines of additional initial jobless claims. So the pace is slowing in terms of amount of people coming into asking for unemployment, okay? And so has it topped? We don't know, but we can say, hey, it's slowing down in terms of the pace of amount of people being laid off, furloughed, losing their jobs. And we have other news such as the Philadelphia Fed Regional Manufacturing Index plunged to lowest levels since 1980. We have new home construction slides 22% in March. And there are some, such as at Fannie Mae, saying home sales will decline by 15% in 2020. Okay, so we know this shouldn't surprise anyone, and the market actually ticked up off of this type of information. We know bad data is going to come maybe for months now, but at the same time, some are betting that the pace or rate of change of some of this bad data is slowing. And then there is discussion that the world's slowing down on coronavirus, or at least some of the hot zones are now seeing some peaking kind of activity or statistics. So this is a daily chart showing the 10-year note price-wise, and then the Christmas type colored candle chart, green-red, is the S&P 500 spot futures, or may actually be cash. At any rate, what we can see is the markets hesitated here a little bit on the S&P, but we can see the bond markets rallying. Now, the correlation, the strong correlation we saw earlier this year would suggest, well, if they're buying bonds, they should be pulling money out of stocks. Well, the problem now is with all this Fed money, Treasury, government policies, all three basically pumping money, that at least the banking system within Wall Street, which is obviously a significant component of Wall Street, is probably buying bonds and stocks. Okay, so I'm not so sure this correlation is working, and the model, which had said to be bearish here now into May, is certainly looking wrong at the moment, and it's revised saying, okay, what's going on is a level 3 top is now due. It's come out of a level 3 bottom, and it's actually looking quite well subjectively. It's got the pattern of it, but it may top any day now. And it is short-term overbought, but just getting so. And probably should top no later than early next week. So we could get a little dip in bonds, but more than likely it's just going to rally for the next level 3, meaning it's possible we've got a larger intermediate, maybe level 2 type uptrend. And I'm just wondering, maybe somehow this fits with our idea that stock market should back off by May, and can peak anytime now into the first week of May. And maybe eventually we will get a little setback in bond prices, a little tick up in interest rates or something. But I'm just wondering, are we going to actually get some selling from that? So I'm not convinced we really got the correlation there that we once had, but I'm not seeing a reason to change our forecast for a setback eventually here into May for the stock market. Now this is an intraday chart. It's a 3-hour chart, and we want to show a little bit of what's going on. Back in April 3rd was a level 3 bottom. That's an intra-month, so your biggest trend during the month, and we can see they bought, and maybe they're still buying, but the point is it's time to dip into next week for a level 3 bottom. With this then, inside of this level 3, we have level 4 buyer-seller interest swings. Buy, sell, buy, sell, buy, sell. And now, in theory, it's going to a buy, and we should see a level 4 top sometime today into early tomorrow. But I'm concerned that this thing is topping out and quite possibly creating a head and shoulders top. This is a shoulder, a head, and a shoulder. And that's just a sign of losing demand. Okay? This trend line from level 4 bottoms really hasn't worked too much. You can see a little bit of intraday respect and a little bit of respect right now. All right? But when it violates a trend like that and then comes back and touches, you have to be concerned if it's going to bump its head and turn lower. And that's a pattern that I call an LPD, or last point of demand, meaning strong demand, not so strong, not so strong, and now is turning into weak demand. Or in this case, it's so short term, I'm not so sure it's demand in the sense of pushing balance sheets for supply and demand as much as it's just buyer-seller interest. So what I want to watch out for is if it takes out the low that we saw overnight, in other words, today's current low, takes out 27.46 for the June S&P mini futures, I think that's a sign that it's rolling over for that L3 signal and pull us back into tomorrow. Now there's still upside objectives and there's still time to rally. So we just don't know. And as we look inside this intraday swing, the model's saying, yeah, it probably should bounce. But I'm feeling like the way the data is coming in right now, the news cycle is tipped a little more to the bearish side. I'm a little concerned that the market's overbought short-term enough that some of these traders, the fast traders and the quants and the computer-type trading, is considering a refocus towards that negative data. They want some more additional reasons to be bullish here. They understand, even if we've started a new bull market, we can retrace 50, 60% of what we've already seen for a rally, and that would just be normal behavior. So they're probably in mode of trying to protect some profit if they have profit. If they were short, they may be considering, do they want to put some shorts back on to see what happens? And then, of course, if you're bearish, you have to consider, is this an opportunity for another sales? Bottom line is, we can be early here for looking for a top all the way into this month, but basically looking out to May, the forecast is we ought to see some kind of setback here, and it's just a matter of will it be large or is it going to be minor because we've actually found some type of long-term bottom. As always, manage your risk and that relative analysis of others and your own. Thank you.